Good morning, everybody, and welcome to this week's long-form episode on Mining Stock Daily. Trevor Hall, your host once again. There was a huge amount of data thrown at the markets this week, including an FOMC meeting where they left the U.S. Fed funds rate unchanged, leading more speculation to what could possibly happen come September with growing pressure to lower interest rates once again from all sorts of different directions. We're going to pose this question as we approach tariff deadline, August 1st, the morning that this episode is released. So we're welcoming in back to studio Barry Knapp of Ironside's Macroeconomics to just go through this trove of data, get some of his thoughts on what we are witnessing in regards to the market data, and then also with Fed policy, tariff policy as well. So great conversation with our friend from Vail, Mr. Barry Knapp. Special thank you to Visa Silver, Integra Resources, Equinox Gold, and Reviva Gold for their continued support of Mining Stock Daily. We're going to have a little bit of a quieter week next week. I promised my wife we'd spend some quiet time away from the kids, and also just to kind of try to have a little bit of a last hurrah for summer. So quieter week next week, just to let you know. All right, everybody, let's just jump into this conversation with Barry Knapp. Have yourself a wonderful, great summer weekend. Be well. All right, Barry Knapp, welcome back to Mining Stock Daily. We have so much to cover. We're not even to the end of the week.
I know.
It's wild. So we're recording this conversation Thursday morning. So we got one more trading day and one more day of economic data to be had. So who knows what the next 24 hours has in store for us, Barry. Your note from Ironside's Macroeconomics, your note earlier in the week, you titled it Macro Investing Super Bowl Week, because we had a little bit, or actually we had a lot of everything this week, didn't we?
We certainly did. I mean, we had lots of news on Treasury financing, and that I would say went most smoothly of any of the potential developments. Besant is a steady hand at the helm. I've described, even on Twitter, Janet Yellen as having been reckless with her handling of her so-called checking account, the Treasury General account, but she effectively turbocharged Fed easing in 2021 by stopping issuance and draining that account, and then turbocharged tightening in 2022 by rebuilding those balances. And she just had no idea what she was doing, and no one at the White House had any idea what she was doing either, as far as I can tell. Treasury Secretary Besant is just the absolute antithesis of all this. So he was left with a very difficult situation, excessive amounts of issuance in the front end of the curve, record levels of debt, and a large deficit. But so far, so good. And I would say the measures that we'll call them our bond vigilante indicators, things like 10 and 30-year swap spreads, the 30-year TIPS rate, which is the part of the curve least impacted by the Fed's balance sheet or rate policy, and the term premium have all been fairly stable through the passage of OBBA and the quarterly refunding announcement this week. So he's a steady hand, and so far so good on that front. So I think for now we can set that risk of a disorderly increase in long-term Treasury yields. We can leave that aside for now.
Okay.
So we still have the Fed and the economic data, the detox process, so lots more to cover.
Yeah, well, maybe let's talk about the Treasury here. I mean, was one small part of everything that got dumped on us this week, and I want to ask you, because you've expressed a little bit of concern, like there's real source of risk out there in the later part of the curve here. Does this week's movement, does that alter any of your kind of underweight stance there on that part of the curve?
I'm going to remain underweight from a structural perspective and suggest that people be in the front end and belly of the curve, because I think the Fed got it completely wrong, and they will be easing in September. I have much more conviction about that. I also think that the detox, slowing of growth as we detox from our addiction to government spending, and we should talk about the GDP numbers this week, really have shifted the balance of risk for the 10-year Treasury to higher prices and a break of the 430 to 460 range to the downside. So, yeah, for a trade or speculative, more speculative position, I would be long the back end. It's just not my favorite position right now. But I do think that the risks of a disorderly increase, for the reasons I discussed, in Treasury Secretary Besant handling the government's finances in a much more adept way, mitigates a lot of that risk for now. I do think by the time we get to the midterm elections, we'll make progress on the deficit. If you look at the CBO scoring using current policy, not current law, but current policy, they estimate that the One Big Beautiful Bill Act will reduce the deficit by $400 billion over the 10-year time horizon. That's not a large amount of money, and spending is still too high, but that doesn't integrate tariff-related revenue either. So I think what we're going to see is a slight contraction of the deficit over the next year and a half or so, and then we'll get to, assuming the Republicans lose the House as sort of standard operating procedure, 2 years into a presidential term, any progress on getting spending from 23% of GDP back to the 20 we've discussed as critical to stabilizing our debt over the long haul will likely stall out. And so this problem hasn't gone away, but for the next 6 to 12 months, 6 months at least, I think that the risks are for higher bond prices, lower yields in the back end, at least the 10-year part of the curve, than any repeat of what happened last year or 2013 for sure.
Yeah.
2023. Sorry, not 13. Sorry.
I want to come back to, you mentioned the One Big Beautiful Bill. Who did you mention anticipated the deficit to come down about $500 billion or something? Because, and I just want to. Oh, go ahead.
Yeah, let me dig in on that just to be very clear to everyone about this. So, if you look at take the CBO, who is the official scorer of this, right? That's the Congressional Budget Office. The official score, the way the law was written back in 1974, was they need to base budgets on current law. So based on current law, those marginal tax rates were due to expire. And so the extension of those meant that the big, beautiful bill was going to increase deficits by $3 trillion over the 10-year time horizon. Right. That is absolutely wrong. And the reason it's wrong is clear from history. And the history is that receipts as a percent of GDP have averaged 17.1% since 1947, subject to a very small 80 basis point standard deviation by each 4-year presidential administration. So if you think about what that means, there's been a myriad of different tax policies. Top marginal tax rates as high as 90, as low as 28. But within a year, we always come back to that 17.1%. So what the Senate did in order to push the budget through was they decided to use current policy and assume we're at 17.1%. If we don't change those tax rates, we're still going to get 17.1%. And history supports their approach. So this is why I'm saying the CBO then created an alternate score using that approach, current policy, not current law, and said, no, this won't increase the deficit by $3 trillion. It will reduce the deficit by $400 billion. Now, that's only $40 billion a year. We're running $2 trillion deficits. So it's effectively an unchanged deficit. but it's not an expansion of the deficit. The thing that expands the deficit is spending, right? Because while receipts are endogenous to the economy, spending is exogenous. It's set by Congress. That averaged 17.6% of GDP through 1981, and we basically were able to wind the World War II debt from over 100% of GDP down to 34% by the early 70s. It stayed there through 1981, and then spending went to slightly over 20% of GDP through 2019. During COVID, it exploded for 2 years to 30% of GDP, and then was put on a 24% of GDP glide path for the next 10 years through all of the Biden administration's expansion of social safety net programs, industrial policy, the Inflation Reduction Act, all those other programs. So the key is, in order to get that debt to stop increasing at the rates it's currently projected to increase, you need to get spending back to 20% of GDP. It's the only path to stabilizing debt to GDP. And the big, beautiful Bill Act makes a little bit of progress, a minor amount of progress. Tariffs will raise some more revenue for a time, let's assume. And then there's going to need to be more actions taken to get it to 20% of GDP. What I was suggesting earlier is that process will likely stall out if the Democrats take over the House in 2026, right? And so at that point, then this problem will return with a vengeance, but the bond vigilantes are going to be quiescent, I suppose, for a period of time, is my assertion.
Okay, so let's play some hypothetical, because midterm elections are more than a year away. Anything could happen. But so let's just say all else equal. What else could be done? You just mentioned kind of things that have been done, put in place to kind of chip away at bringing that government spend of GDP back down. We're not quite, I mean, we're not even close to getting there yet.
Right.
But what else could be done to drop another, 2%?
Well, there's likely to be a bipartisan healthcare related bill later in the year. Republicans have started working on it, and they intend to make it bipartisan. So we'll see if there can be more reform on healthcare spending. That has been a big driver, and that's where much of the growth has come from. Obamacare subsidies, Medicaid spending is up 51%. They've enacted work requirements. I don't think anyone in the public really objects to that, other than just using political language to describe that. But asking able-bodied men, to work 20 hours a week to collect Medicaid, it's not so unreasonable. So healthcare is a key element of this. You also have the annual appropriations process. So there's potential discretionary spending cuts. There's a potential for another reconciliation bill later in the year that makes some other attempts to reduce some of the spending increases. So there's lots of areas. I mean, we operated at 20% of GDP from 1981 through 2019. We don't really need to be at 24% of 23.4 is this year's number. Most likely, we only have 3 months to go, but we don't really need to be at that number. I'm sure we could find a way to get it back. It's just, as you know, it's harder to take things away from people than it is to give to them for politicians. But there's a number of steps. And then there's also other subtle things. The man to watch on this, everyone got real caught up in Doge and Elon Musk. The guy to watch is Russ Vought, who's the head of the Office of Management and Budget. And he's talking about things like pocket rescissions, where at the end of the year, if they haven't spent money, President Trump can just decide not to spend that money as the executive, and Congress has to act to overturn that. So people ask, are the Doge cuts ever really going to happen? Yeah, that's how they'd happen, right? As pocket rescissions, perfectly legal maneuver. So there's lots of little steps that can be taken. And Treasury Secretary Besant said it all along, we can't reduce spending by 3% of GDP in a year. that will shock the economy, which really does lead into this discussion of GDP and that detox from our addiction to government spending, because we've now had 2 quarters in a row of negative government consumption at the federal level. And that's after it just surging for the last 4 years. And in particular, last year in the quarter right before the election, it was up 8.1% quarter on quarter annualized. So sort of typical pattern, spend as much as you can to try and pump the economy up before the election so the incumbent can win. But, we have had a decided slowdown of government spending. The latest monthly Treasury budget number and CBO number showed a 7% drop year on year in government spending for the month of June, that is, 9th month of the fiscal year. So there's, this is going to be an ongoing process. But make no mistake, this has had an impact on growth, and it was always going to. I wrote a report in February titled Cleaning Up the Industrial Policy Mess, and my idea was we'd reduce government spending and then pass the reconciliation bill and have a recovery in capital investment in the second half of the year. Treasury Secretary Besant, I was on CNBC talking about that, and then Treasury Secretary Besant went on 3 days later and said the same thing much more colorfully, which was our detox from our addiction to government spending. But if you look at what's going on right now, we've had these 2 quarters of reduced government spending or dropping federal government spending, and consumption has slowed decidedly, particularly consumption of services, which is a second order effect of that plus the tariffs. To be sure, the tariff tax is slowing spending. When Chair Powell talks about the inflationary effects, my head almost explodes. I mean, it is so clear when you look at corporate earnings, the earnings from discretionary companies are down. The earnings from staples companies are down. Their revenue growth is weaker. So the tariff tax is reducing aggregate demand of not just goods, like goods surged in the first quarter because people tried to front run the tariffs. Autos are a great example. Now they've come back, but it's reduced demand for services. Look at what's happened to airfares, right? And airline stocks have gotten crushed as a consequence of this. And so you are having this real hit to growth, which is what the market said in April was going to happen, that this was not going to be an inflationary shock. It was going to be a bigger hit to growth. And that's exactly what happened. So as I said, discretionary earnings are down, revenue growth is weaker. So they have reduced demand and they have pressure on their margins. That doesn't cause inflation, right? Powell even said it himself yesterday. Oh, well, these companies all intend to pass prices through, but they just might not be able to do it. Well, no kidding, they can't do it. That's really obvious, right? If they could, if they would. And the reason they can't is in 2021, when we had the inflation surge, the government mailed $400 billion of checks to everyone. There's no checks going out right now. The fiscal policy is going in the other direction. And this is the Fed, one of the Fed's fatal flaws in their framework is they refuse to acknowledge the role of fiscal policy in the inflation process, the fiscal theory of the price level. They get that completely wrong. So monetary growth is way below its long-term average. Fiscal spending is in reverse. So you have a tariff tax, and what happens? Demand goes down. You don't have inflation. You have demand go down.
So how do you explain the 3% GDP for Q2 that came out? I mean, surprised the living hell out of everybody, Barry. I mean, maybe not you. Maybe you saw it because
no, it was weak. It was weak.
3%.
It's weak. It's weak. Forget the headline number. It's nonsense. The headline number is absolute nonsense. You need to take out trade, net exports, and you need to take out inventories. So inventory surged in the first quarter. Trade, net exports, the surge in imports caused a big negative to GDP. And then in the second quarter, that reversed. So Chair Powell refers to this all the time. It's called PDFP. It's private domestic final purchases. So all it does is take GDP less net exports or trade and inventories. That averaged 3.2% in the second half of last year. It was 1.9% in the first quarter. It was 1.2% in the second quarter. Services spending has slowed from over 3% to just a little above 1%. So core domestic demand is weakened decidedly. Growth is weak. That 3% GDP number is meaningless. I mean, you could average the two and then you get something a little over 1% as well. But that's not even really, that kind of gets you to the same place, more or less. But that primary PDFP measure really gives you the clean read on what's going on with domestic demand. And it's basically a third of what it was in the second half of last year.
It's crazy. I mean, I'm glad you explained this to me, because it just sounds like it's like the ugly thing behind the curtain. Like, everything in front of the curtain is beautiful. Like our good friend Jared Dillian said, President Trump's going to be dining on that GDP headline number for the rest of the quarter because it looks good. But you're telling me behind the curtain, it is like we are seeing drastically weakened growth on the back of services. But it seems like this is the best of both worlds. They get something that looks great that they can use to politique with, but then they also need to lower growth because they have so many problems that they need to come to terms with here.
Yeah, I mean, politicians always gaslight a little bit, but
Sure.
the proof is in things like the Russell 2000, small cap banks. Russell 2000's down 240 basis points over the last 5 days. I was on CNBC Asia last night, and I said, yeah, S&Ps look great because of Microsoft and Meta, but the Russell futures are down 60 basis points, right? The most economically sensitive parts of the economy are struggling because growth is weak. And one of the key elements for me to look through this detox process, because make no mistake, I'm positioned for a recovery in capital investment. And if in a year's time we have weaker consumption but stronger investment, that is a much better mix of growth for investors and for the long-term productivity of the economy, ultimately per capita income and people's general welfare. We were consuming too much and not investing enough, right? We were asking the government to do the investment, not the private sector. It's a bad approach. I know everyone thinks investment's strong because of, Microsoft and Meta and all the money that's getting spent on the AI build out and data centers, but it isn't, right? In every other category, it's been falling for 3 years. And so that's really the key, is that we make it through this transition. One of the keys for me to make it through the transition was a Federal Reserve that would begin to ease the pressure on the small business sector, right? And they don't get it. And they don't understand housing in particular. I mean, Chair Powell's, when he asked about housing yesterday, said, we have a housing supply problem, and inferred it was all due to local zoning or something, and had nothing to do with the fact that the Fed bought every mortgage-backed security in sight in 2021, drove the spread of mortgages to treasuries to all-time lows, which attracted private equity capital, caused people to get locked in their homes, house prices to go up 46% in 18 months. And then when they tightened, they tightened primarily using the policy rate, not their balance sheet, which caused the longest inversion of the yield curve, 3-month 10-year part of the curve, sort of a proxy for bank profitability in history, caused regional banks to go bankrupt. The relative return on equity of small banks versus big banks is a 4% spread right now. Those small banks are not earning their cost of capital. Subsequently, they're not providing any credit to real estate developers, mom and pop builders in particular. And the Fed has totally impaired the supply of housing. So this has just been disastrous, absolutely disastrous policy. And it carries no inflation risk to reduce that policy rate and actually get to an upward sloping curve that would reopen that bank credit channel. That's not what caused inflation in the first place. They caused housing inflation. So there's just so many things wrong with the Fed's policy. But what that does in aggregate is we have this slowing growth. We're waiting for capital spending to rebound away from just AI more broadly. And if we had a Fed that was starting to ease pressure on these small businesses, small banks, that to me would have allowed, the Russell 2000, which broke above its 200-day moving average about a month ago and looked promising when it appeared that the Fed was moving towards a SEP easing restart of the process. I think it leaves the equity market vulnerable to a growth scare related correction. And we've had a number of those in August in recent years. So, tomorrow's report is critical to all this. Chair Powell, I think, is wrong about the labor market. His thesis is that the supply is coming down, and that is certainly true with immigration being tightened. But he's saying demand is falling at the same pace and citing the unemployment rate as the key indicator of the labor market being in balance. I absolutely disagree with that, partially for a technical reason, which I'll explain. It's quite simple. We had the annual population adjustment from the BLS, where they adjust the size of the working population. They do it every January. The year before, they said that the population shrank by 625,000 workers. That's in 2023, when we had the biggest surge over our border in history. And my source for that is the New York Times, past 1890, right? On a population adjusted basis. But they said the population shrank. This year, they said the population went up by 2.9 million workers. They just found all the dudes that showed up in 2022 and 2023 suddenly. So it just shifted the whole baseline for the calculation of the unemployment rate, because they don't go back and smooth it over time. They just boom, 1 month, we get this much bigger population. So if you look at labor force growth and employment growth, it's sliding and then it jumps. And then it's sliding no. This looks like a mess. Be careful. Yeah. The most important price for me is wage growth. And when you look at the Atlanta Fed wage tracker, what you see is the lowest income quartile, the one most impacted by that surge in immigration, those wages are plunging. And so that, along with job switchers, wages are also plunging. So that looks to me like a loose labor market, one that has increasing slack. I have an index I created of 18 different labor market slack related indicators, and it had a big jump indicating much more slack in the month of June. And I think there's a lot more slack in the labor market than Chair Powell is giving it credit for. And the issue is, if they fall behind on their employment mandate and people are unemployed for long periods of time, and you had things like a big jump in discouraged workers in last month's report, you had a big jump in long-term unemployed, so that's greater than 27 weeks. If people are unemployed for long periods of time, there's a real skill erosion, and they become harder and harder to employ. That's called labor market scarring. It was a big problem in the aftermath of the global financial crisis, and that's the risk that the Fed's taking right now. So I've just found two major flaws in how the Fed thinks about things. One is they do not acknowledge the role of fiscal policy in the great inflation in the 70s, in inflation in 2021, although any market participant knows when you send checks to everyone when supply chains are impaired, it's just going to drive the price of goods through the roof. And sure enough, within 3 months of sending those checks, goods, CPI goods, core goods prices went from increasing at below 2% to 12.4%. 3 months. So It's obvious what happened. So there's a flaw in the way the Fed approaches inflation, and their flaw in the way they're approaching unemployment is just rolling the dice on the unemployment rate when there's a whole range of indicators that suggest that the labor market's softening. And there's a number of Fed governors that agree with this. Obviously, Waller, first and foremost, and people are saying, oh, it's political. No, the man laid out a very articulate argument that I agree with almost every word of. Bowman's on his side. Mary Daly gave a Bloomberg interview right before the lockdown period, the quiet period, that indicated she was on board with this. And there's a couple of others that are getting increasingly worried about the labor market. So that makes tomorrow's report really crucial.
I know you don't, you and I don't chat a whole lot about physical commodities, but there's a couple like anecdotal headlines that I wanted to share with you and just kind of get your thoughts and pick your brain. I do want to talk to you about the copper rug pull that happened this week. That was a crash. And I'm going to table that topic here, Barry, just on bigger scale of what the tariff and trade policies mean. But at first, I want to go. I want to go to the Midwest. Being a Midwest boy, being a Nebraska boy myself, I tried to pay somewhat attention to what the agriculture markets are doing. I mean, they are down in the dumps. Grains, corn. I mean, they're all just really hanging on by a thread here. Unless you're a cattle rancher, I mean, cattle prices are basically hitting an all-time high every week lately. That's good. But I just read a headline from the great state of Nebraska, where I'm from, saw its like worst, its GDP shrunk more than 6% in the first part of 2025. The heartland of the United States is really struggling with these prices. In fact, somebody is quoted within this piece I saw, and again, just anecdotal, you can take it however you will, but he's comparing this time period to what they witnessed in the early 80s. And that's actually early 80s is when my family lost the farm because it was a terrible time to farm. Is this something like, if you're back on Wall Street, working for any one of the institutions that helped you cut your teeth here in your career, how closely are you paying attention to this stuff that's going on in America's heartland?
I grew up in farm country, believe it or not. Storrs, Connecticut is just filled with dairy farms. Now, we had mostly college professors' kids that I went to high school with, but I went out for a run. I ran past a dairy farm, and I've always thought about that stuff. I tell people I'm from Connecticut and they think I'm from Greenwich, right? But it's not the way I think about things. And listen, I think this is all consistent with how I described the tariff process working is if you don't have accommodative monetary and fiscal policy and you put a tax on something like imports, it is going to reduce aggregate demand, right? And I would assume that the problem with ags is, and I've heard a lot of talk about this, even, not someone who I would typically quote, Jim Cramer talking about the K-shaped economy again, right? And, it is certainly true that, and that's been one of my biggest arguments for the last couple of years, is that when the Fed decided to ease primarily using their balance sheet, that was a boom for households that owned assets, owned homes, owned stocks, owned bonds. But it didn't do very much for people that lived paycheck to paycheck. And when they tightened, primarily using their policy rate and only passively unwound their balance sheet, they put all the burden of tightening on people that finance at a floating rate, households that live paycheck to paycheck. And so this is just, they did it supposedly in the name of, communication and sending signals to the public and their overestimation of the impact on forward guidance and setting of inflation expectations. But they've created a very tight set of conditions for Joe Sixpack. And then, when you put all these tariffs, and the goals may be worthy, right? I mean, we have this incredibly unbalanced economy, and it's not because we just consume too much. It's because China has created a policy of just dumping product on the rest of the world. And you might even notice that the Chinese renminbi, which is virtually unchanged through this whole process against the dollar, has fallen 11% against Europe. Because guess where all that product is going to go now? They're going to dump it on Europe if Europe isn't careful. So there's a lot of stuff to be worked out here. And this is why, for me, I just don't understand how the Fed can't see these things. They're so clear. They shouldn't be fighting the tariffs. They should be trying to ease policy for the people that are struggling with it. And so I was upset when they reduced QT from 25 billion a month down to 5. Even when they reduced it from, where were they, at 80 to 25, they were only going to go to 30. They didn't even need to go all the way to 25. And then they went to 5. So they're still protecting big banks and holders of assets at the expense of the people that live paycheck to paycheck. And those are people in the heartland. Those are mom and pop developers and builders. And it's just, it's like, I get it. You sit in Washington, maybe you don't understand this. I don't know how you don't. I mean,
with the maybe the other side of the debate here, I mean, the concern about decreasing rates, and I mostly agree with you, Barry. Like, I do, but I also want to try to see the other side. I mean, maybe the concern is, or maybe, and you can provide some color on this. You start decreasing rates, all of a sudden, what does that do? Does it bring new supply of housing on, or does it
yes.
re-escalate that speculation in, deeply risked, meme stocks, cryptocurrencies, like all those things? We've got a stock market that's already running hot. I mean, does this just further escalate a lot of that? Really deep speculative things?
What I envisioned as optimal policy at the beginning of the year, and I wrote a lot about this, was the Fed continued on with QT in a much more aggressive way than they did, and started to ease the policy rate. That easing of the policy rate, they could then balance QT with the Treasury extending issuance in the long end and start rebalancing policy. Do this in a more coordinated way. A lot of people will point to the Fed Treasury Accord of 1951 as the point when the Fed gained their independence. And certainly compared to the rate caps that they had from 1942 to 51 to finance World War II debt, yes, they appeared to gain their independence. But in reality, what went on for the next 20 years was coordinated action between the Fed and Treasury to slowly wind down the excessive debt from World War II. We need to do the same with the excessive debt that was accumulated during the pandemic war. It was warlike spending for sure, right? And so a much more optimal policy would be the Fed being more aggressive, winding down their balance sheet and bringing that policy rate down so that the curve is upward sloping. That would also allow small banks to accumulate mortgages. That spread between mortgage-backed securities and treasuries right now is 150 basis points. If you use the Fannie Mae current coupon 30-year TBA rate against 7-year treasuries, which is roughly the duration of a newly issued mortgage, that's at 150 basis points. It should be at 100. But it can't be because small banks are leveraged buyers and the yield curve's flat. So there's just not enough VIG in it for them to buy them, or REITs, for example. So this could be done in a much more structured way that would then, make financing more attractive for mom and pop builders. And there's surely the demand there. One of the charts I'll show this week is how strong residential investment was in the 70s amidst much higher mortgage rates, a much higher unemployment rate because of that demographic from boomers forming households. The millennial demographic is even bigger, but yet we can't get that construction going because the cost of capital is just too high. And of course, they got hit by the tariff tax as well. So it's another reason why if the Fed eased the policy rate, it would offset the cost of materials and stuff that's imported as well. So, I heard my old colleague Rick Reeder talking about this on television not that long ago as well, that reducing the policy rate would actually increase the supply of mortgages and bring down housing costs and prices because of, you've got people locked up in mortgages and all. You reduce that mortgage rate by 75 basis points or so, it's not going to cause house prices to suddenly leap. There's a lot of people that would die to sell, and there's a lot of people that would want to buy. It would just increase turnover, and it's not so clear that that's going to result in higher prices. Probably would bring prices actually into equilibrium. Right now, you've got just this people locked in it. So
Yeah. I will say, I've noticed, at least in my part of Western Denver Metro, there's a lot more homes with for sale signs that are those for sale signs are up there a lot longer than they used to be. The turnover just isn't there. So
no, that's right. And there's a lot more inventory up here in Vail, which is luxury inventory too, right? I mean, it's a different market, but even here, supply is starting to increase. I mean, over time, people just need to move, right? Like someone bought a house during the pandemic, and now they've got to move. They've got a new job or whatever. And that's another issue that's been created is turnover in the labor market has absolutely collapsed. And it's back to like 2013 levels when the housing market was very impaired. And so the way the Fed conducted policy tightening just was really super suboptimal. And I just can't emphasize enough how important it is to get someone, I think the Fed should have a vice chair for capital markets, right? Someone with a set of experiences like Treasury Secretary Besant, who would understand all this stuff, knows how to read markets. Larry McDonald, right? Read the markets. What's the market message? Those of us who've been doing this for a long time get it, but there's no one at the Fed like that. And it's, it makes me partial to Kevin Warsh because he spent more than a decade hanging out with the master, Stan Druckenmiller. So Kevin's surely going to know how to read markets, and he's going to keep talking to Stan, and Stan will tell him what it all means, right?
Right.
And that's therein lies a lot of my criticisms. But listen, the broader bottom line for me is, I do think this capital spending recovery is coming. I do think that the corporate incentives in the One Big Beautiful Bill Act, making equipment immediate expensing permanent, R&D expensing permanent, that provision that will last for several years to build a factory, those are powerful incentives. And we've underinvested in our capital stock for a long period of time. I do think we're going to get a capital spending boom. It's a question of timing. And so I want to lean into those sectors that benefit from it. Tech is tricky, right? Because we know how expensive it is. Early in the year, the rate of change of earnings growth of revisions was going down, and the sector got clobbered. They answered all the questions, but I don't know. I look at Microsoft going up 9% on an earnings surprise, and you've got to think that this is going to be ebbs and flows, right? And yeah, you want to be invested in that theme, but it's hard because it's expensive. Right. Investing in things like industrials for a broadening out to a broad range of sectors, and industries that are investing because of those incentives, materials, and even energy, that to me makes more sense. And I think that President Trump has gotten the message that a $50 oil price won't work. Now, I spoke at an event down in Denver, a group of CEOs who have lunches periodically. I'm not sure if it's monthly or otherwise. And I was the guest speaker earlier this month. And that was one of the discussions we had was, drill, baby, drill does not work below $70 a barrel. And so, yeah, we need tons of nat gas for electrification. We need to build all this stuff out. But even to do, the development of these other resources, if you've crushed the profits from oil, there's not going to be the cash flow to invest in other stuff. So yeah, I wonder, based on some of the things I've heard out of OPEC, if President Trump hasn't gotten that message that, yeah, okay, MBS, that was great. You helped me out a little bit at the beginning, but we don't really need a $50 price. It's going to kill us.
I want to pivot here and also finish up the conversation because I'm going to ask you about the copper announcement with tariffs. And I'll kind of pair that back, because you've talked a lot about the sequencing of trade policy, or maybe the lack thereof sequencing, at least coming out of the White House. And we saw the news, yesterday on Wednesday, where we went into the week expecting a 50% increase in copper imports on basically everything. We get it gets kind of it gets singled out, like refined copper is not on that, and so then we see to this day a 25% pullback in the COMEX copper contracts here, just a complete rug pull, a crash. But it just made me think, it's like, okay, if you are working with these policies and you are beholden to news headlines, how it just seems unmanageable if you are trying to work within the ecosystem of this and being prepared for a CapEx build that you think is coming down the pipeline, in the future. So how do you kind of pair this? Like, I mean, it's literally chaos on the trade policy side of things, with needing clarity, and just if you could provide a sequence of what this is actually going to be. It's like, okay, now we can prepare for the next 3 years of building out whatever it is that we need to build out.
I don't know whose idea that was. I would love to know, actually. I strongly suspect it was either Navarro or Lutnick that came up with that idea. I don't know how you could possibly imagine that we could increase copper production that quickly to be able to overcome a 50% tariff on the raw material. Yes, we've got copper resources here that we haven't exploited for all sorts of environmental EPS type reasons. Yeah, maybe we should loosen that over time and develop more of our own resources. But who thought that just slapping a 50% tariff on that raw resource made any sense? And it's almost as if Navarro thought it up, and then Besant heard about it and said, "What are you doing? This is insane." So I don't know. I mean, Trev, you make really good points on all that. I was critical of the trade surplus penalties, and there's the hearing going on today at the appellate court over the use of IEEPA, something that I wrote about before the Court of International Trade ruled that I thought that it was a huge stretch and likely unlawful. IEEPA's intent was not to give the president more power. It was actually to curtail his powers over sanctions. And I thought the use of that for reciprocal tariffs was really questionable. Surely you can have sectoral tariffs. There's a law that very clearly lays that out. This copper tariffs didn't seem to follow that process, really. There clearly couldn't have been a 6-month investigation to justify them. So just like slapping tariffs on Brazil because you don't like the way they're treating Bolsonaro, which, by the way, it does look, pretty crazy the way they treat Bolsonaro, but, you just can't use trade policy that way, right? I mean, that's not the way the Constitution was written. So, yeah, those are all very valid concerns, to be sure. Makes it difficult, I think if you're Freeport McMoran or whatever, you just have to take a deep breath, say when those announcements come, just close your eyes and no, I'm not going to wait a week or so. And
yeah, they got the equity of Freeport got crushed yesterday. It's bouncing a little bit today, I think, as people kind of realize that, we're a little bit more stable than they thought. It was just completely speculative short yesterday. But Barry, thanks so much for your time. It's really good to connect with you. We covered a lot of ground, just a wealth of information in there that you provide us, every time we connect. For just before we let you go, let everybody know about Ironsides and where they can find the newsletter.
Sure. The main site, our main site is ironsidesmacro.substack.com. We use Substack to house our product, and we produce a very detailed report on a weekly basis. Comes out Saturday mornings. It has equity market sector recommendations, asset allocation recommendations. We go through, monetary fiscal policy, the economic environment, the market backdrop, and try and help you invest your money. I was an institutional strategist and advisor for quite a number of years. When I started Ironsides, I started providing the product to the public as well, making it approachable. And yeah, we welcome everyone to have a look. If anyone wants a trial for a period of time to get to know the product, by all means, let me know, and I'm happy to do that. There's a abbreviated free version that goes out and a free video that I produce every week. That's, as I said, it's abbreviated relative to the full, more robust product that I think is pretty good for, if I don't say so myself.
I will say so for you. It is really good, Barry. All right. Thanks Barry, and thanks everybody for listening. We'll be back an abbreviated week next week, as I will be traveling. We'll be in and out of the studio. So Barry, thanks so much. We'll talk to you again soon.
All right, Trev.